Welcome to the Opening Bell Report.
And if you're joining us for the first time, we always like to think of you as the third person sitting right here at the table with us, just ready to sift through all the noise and find the actual story hiding beneath the headlines.
Right.
And today, we have a bit of a mystery on our hands. We are going to be looking at an incredibly intriguing analysis report centered on a microcap company called Decent Holding Inc.
Yes.
They trade under the ticker symbol DXST. And the goal here today is an in-depth DXST stock analysis uncovering the hidden 68% core business growth.
Framing this as a mystery is honestly the perfect way to look at it because, when you first pull up the stock chart for DXST, it does not look like a fundamentally grounded company.
Not at all.
Right. It looks like a wild, unpredictable roller coaster. It's the kind of extreme volatility that makes most traditional conservative market watchers just immediately look the other way.
Which is completely understandable. I mean, the market is flooded with data, and it is very easy to see a chart moving like a heart monitor and assume it's just noise.
Exactly. Just pure speculation.
Right. But the mission of our deep dive today is to look right past that surf-in-level chaos. The analysis report we're unpacking reveals something the broader market seems to be completely missing. We're looking at a hidden growth engine sitting right in the middle of their core business. And I want to emphasize right out of the gate, you sitting right there listening, you do not need to be a Wall Street trader or have a degree in finance to appreciate the mechanics of a turnaround story like this.
No, not at all.
We are going to walk through the business realities step by step.
And honestly, that is the most valuable part of doing this kind of deep dive.
Yeah.
The financial markets are notoriously dense.
Oh, they love their jargon.
They really do. They use a lot of intimidating terms to describe things that are, at their core, very straightforward. At the end of the day, we are just looking at human behavior, supply and demand, and the actual, physical hurdles of a business trying to scale its operations.
Let's start by looking at the numbers we have here because we do have to address the spark that put this company on the map recently.
Yeah, we can't ignore the chart.
Right. The data details a highly unusual price action event. We're looking at an intraday surge where DXST moved from an opening price of just 12 cents to a high of 29 cents.
Which to someone used to buying shares of massive tech conglomerates for hundreds of dollars dealing with pennies might not sound like a noteworthy event.
Sure.
But in the microcap space, context is everything.
Okay, let's unpack this. Going from 12 cents to 29 cents is a 141.6% jump. It's roughly a 152% upward move in a matter of hours. As someone trying to learn how these markets function, how exactly does a stock move that aggressively, that fast? Is the company suddenly worth twice as much by lunchtime?
That is the crucial question. And the short answer is no.
Shocker.
Right. The fundamental value of the company didn't double in 2 hours. To understand what happened, we need to look at the underlying architecture of the stock itself.
Okay.
The analysis report points out that DXST has what is known as a low-float share structure.
Let's make sure we define that.
Yeah, so for you listening, let's clearly define what that actually means in practice. A company might authorize and issue millions of shares over its lifetime, but the float refers specifically to the number of shares that are actively available to trade back and forth in the open market on any given day.
Got it.
In a low-float company, that supply is exceptionally small.
I always like to visualize this using a real-world scenario. Imagine trying to buy tickets to a highly anticipated concert.
Oh, this is a great way to look at it.
Imagine a massive stadium that holds 50,000 people, but for some administrative reason, the promoter only made 50 tickets available to the general public.
That is highly accurate. If you only have 50 tickets actively floating around, and suddenly 500 highly motivated fans show up at the box office with cash in hand, what happens to the behavior of the people holding those 50 tickets?
Well, the people holding the tickets realize they possess something extremely scarce.
Exactly.
They see the line forming and they refuse to sell unless the buyers are willing to pay an astronomical premium.
Precisely. And that is exactly the mechanic driving the intraday volatility in a low-float stock. The available supply of shares is so restricted that the moment a wave of sudden buying volume steps in, the buyers have to keep offering progressively higher prices just to convince anyone to part with their shares.
Because there's no inherent liquidity.
Right. There's simply no inherent liquidity to absorb the sudden demand. So an explosion from 12 cents to 29 cents is the mathematical result of severe scarcity colliding with sudden demand.
That makes the mechanics much clearer. It's also a great reminder that microcap stocks are notoriously volatile by nature. The same mechanics of scarcity that drive a stock up 150% can drive it down just as fast if the buying demand suddenly vanishes.
Absolutely. It is a dual-edged sword.
Right.
Which is why understanding the actual underlying business is so critical. A stock cannot survive on supply and demand hype alone indefinitely. Eventually, the market demands fundamental value.
And that leads us right into the central mystery. The ticket booth analogy perfectly explains the flashy chart and the sudden price explosion. But if you look past the day traders fighting over scarce shares, someone actually has to be doing the work.
Right.
What is the actual business behind the DXST ticker?
This is where we have to peel back the layers because the analysis report details an operation that is highly substantial. Decent Holding isn't just a digital abstraction. They operate in the deeply physical, critical sector of Chinese industrial waste management.
Not exactly a glamorous dinner party topic.
No, definitely not, but obviously a necessary one.
So what does that actually entail on a day-to-day basis?
Specifically, they focus heavily on ecological river restoration and industrial pollutant removal technology. And it is important to understand the complexities here. Ecological river restoration isn't just a matter of sending out boats to skim visible garbage off the surface of the water.
Right, because if it were just skimming trash, anyone with a net and a boat could start a competing business.
Exactly.
The barrier to entry would be zero.
Right. The report notes they utilize specialized tech to pull pollutants out of the water. In practice, this means dealing with complex chemical realities.
Wow.
We are talking about neutralizing heavy metals, filtering out industrial runoff at a molecular level, and doing so in a way that doesn't inadvertently destroy the existing fragile biological ecosystem of the river itself.
That sounds incredibly complex.
It is. That requires significant engineering, specialized equipment, and deep scientific expertise. That is a massive barrier to entry for potential competitors.
Okay, so they have a highly technical moat around their business. But why now?
If we connect this to the bigger picture, you have to look at the massive shift in Chinese governmental policy.
Right.
We are looking at the aftermath of decades of unprecedented rapid industrialization. For a very long time, the macroeconomic focus was purely on aggressive economic growth, infrastructure expansion, and maximizing manufacturing output.
Basically build fast and ask questions later.
Exactly. But that level of rapid industrialization leaves a massive environmental footprint.
Yeah, you can't run a hypercharged industrial economy for decades without generating an enormous amount of industrial byproduct.
And that bill has essentially come due. The regulatory environment has shifted dramatically. There are now massive government-mandated pushes for ecological cleanup. The priority has expanded from just pure economic output to long-term environmental sustainability.
So there's a huge structural tailwind here.
Exactly. So when you look at a company like DXST, they aren't offering a luxury service. They possess the proven technology to remove industrial pollutants from municipal river systems. They're offering a desperately needed solution to a strictly enforced mandatory problem.
Which perfectly sets up the core revelation of this entire deep dive.
Yes.
So we have this wild price action on the outside, which leads us to ask, what is the market missing? That takes us into the Chinese industrial sector, and here's what the data reveals. While the market monitors were flashing with daily price swings and distracted by the volatility, the analysis report shows a massive expansion happening quietly inside DXST's most important division.
The broader market couldn't see the forest for the trees.
The key metric uncovered here is that the company's core wastewater treatment segment experienced a staggering 68.7% year-over-year surge.
What's fascinating here is what that specific metric implies.
Go on.
In the world of complex municipal and industrial contracts, you do not accidentally achieve nearly 70% growth.
Let me play devil's advocate for a second, though. Could a number like that just be a lucky quarter? Maybe they happened to land one massive, anomalous government contract that skewed the data, but it isn't actually sustainable.
That is a very fair question to ask when looking at microcaps, but that is precisely why the analysis report focuses on the year-over-year metric.
Okay.
Year-over-year comparisons are crucial because they naturally smooth out those seasonal anomalies or one-off quarterly spikes. Sustaining nearly 70% growth over a 12-month comparative period is a clear indicator of a scaling business model.
It's a trend, not a blip.
Exactly. It demonstrates that their specific ecological river restoration technology actually works in the field, that municipal clients trust them to execute these complex chemical neutralizations, and that they are successfully expanding their operational footprint.
And according to the numbers, that explosive segment growth wasn't isolated. It successfully pulled the entire company's top line higher.
Yep.
The data shows DXST grew its overall revenue by 12.2% year over year, bringing in a solid $12.95 million.
Which represents a very healthy top-line expansion for a company of this size, particularly because it proves the core wastewater segment is successfully doing the heavy lifting for the broader corporate structure.
But this is where we have to address the headline number that likely scared off the casual investors who didn't read past the first page of the financials.
Right. the net loss.
Yeah, along with that $12.95 million in revenue, the company reported a net loss of $322,000. The data shows this was driven by a sharp spike in operating expenses.
And this is the exact moment where financial literacy separates the casual observer from the rigorous analyst. To the untrained eye, any net loss immediately looks like a glaring red flag.
Wait, I have to stop you there and push back a little. A $322,000 loss is still a loss. We are talking about actual capital flowing out of the business.
Right.
For a microcap company, isn't burning through cash a legitimate red flag? Why shouldn't a casual investor look at negative earnings and just run the other way?
You should always be cautious about cash burn. That's just smart investing. But you have to evaluate it within the proper context.
Okay.
You have to understand the fundamental difference between evaluating a mature, dividend-paying blue-chip company and evaluating a microcap growth company. For a mature company, a sudden net loss might indicate systemic failure.
Right. If a giant beverage company suddenly loses money, something is broken.
Exactly. But for microcaps, in a phase of aggressive expansion, burning cash while scaling operations is entirely normal and often strategically necessary.
It makes me think of a popular local restaurant that suddenly gets a glowing review and now they have a line out the door every single night.
I like where this is going.
They are pulling in great top-line revenue, but the kitchen is just too small to handle the demand. If they want to capture all those potential customers, they have to knock down a wall, expand the kitchen, buy new commercial ovens, and hire 5 new chefs.
That is a brilliant way to frame it.
Right, because for that specific quarter, there's going to be dust everywhere. The dining experience might even be a little chaotic. And because they just bought all those ovens, their expenses are going to spike.
Massively.
They might show a temporary financial loss for those 3 months, but they aren't losing money because their food is bad or the business is failing. They are losing money because they are building a bigger kitchen to service a massive increase in demand.
That captures the dynamic perfectly. They are aggressively investing in their own capacity. The analysis report suggests that DXST's recent spike in operating expenses should be viewed through that exact lens.
Building a bigger kitchen.
Exactly. They are actively working to capture and service that massive 68% growth in their primary wastewater market. You simply cannot facilitate nearly 70% growth in highly technical industrial water treatment without hiring more specialized chemical engineers, deploying more heavy equipment to the river sites, and spending capital to service those newly acquired contracts.
So that $322,000 loss is basically the cost of knocking down the wall.
Right. It's the cost of expanding the kitchen.
So what does this all mean? We have a company with a temporarily scary headline loss, but an underlying core business that is demonstrably expanding. How does the broader market react to a setup like this?
In this specific case, it creates a profound valuation disconnect.
The data breaks this massive discount down clearly. The stock is trading roughly in the 20-cent range. If you look at the total market capitalization, the value of the entire company, it is sitting at under $10 million.
Right.
Yet, as we just discussed, they are generating nearly $13 million in real top-line revenue. The market is pricing DXST as if the business is on the verge of bankruptcy, completely ignoring the double-digit revenue growth and the absolute boom happening in their core environmental sector.
And this disconnect brings us to one of the most vital concepts in evaluating a growing business,
Which is?
operational leverage. This mathematical principle is the absolute key to understanding the bullish turnaround thesis presented in the report.
Operational leverage is a term that gets thrown around constantly on financial news networks, usually without much context.
Yeah, it sounds fancy, but it's simple.
For someone listening who might not have an MBA, what does that actually look like in practice? Let's walk through it step by step.
Let's use a very simplified hypothetical. Imagine you run a factory that manufactures a specific widget. You have fixed costs, your factory lease, your core administrative staff, the lease on your manufacturing machines. Let's say those fixed costs run you exactly $1 million a year. Regardless of whether you make 1 widget or 10,000 widgets, you have to pay that $1 million.
Right, the fixed costs are the absolute baseline just to keep the lights on.
Exactly. Now, once your revenue from selling widgets crosses that $1 million mark, your fixed costs are entirely covered for the year. From that break-even point onward, every new dollar of revenue you bring in does not cost as much to generate.
Because you only have to pay for the raw materials for the widget, not the factory lease.
Precisely. The profit margins on those additional dollars expand dramatically. A 10% increase in revenue might lead to a 40% increase in net profit. That geometric expansion of profit is operational leverage.
So tying this concept back to the data on DXST, they just spent heavily on operating expenses. They absorbed the upfront fixed costs of expanding their engineering teams and equipment to capture this 68% growth in wastewater treatment.
Yes, they have paid for the heavy lifting. The infrastructure to handle the new contracts is now in place. If management can maintain this trajectory and streamline their ongoing costs, that massive 68% growth in the core segment doesn't just represent top-line revenue anymore.
It becomes profit.
Exactly. Because the fixed costs are covered, a much larger percentage of that revenue starts falling directly to the bottom line as pure profit. Once operational leverage kicks in, earnings can scale exponentially, even if revenue just grows at a steady linear pace.
And because the market is currently entirely blind to this dynamic, pricing them at an under $10 million market cap based purely on the temporary net loss, any realization of that operational leverage could violently reprice the stock.
It absolutely could.
Which brings up the final catalyst detailed in the analysis report.
The squeeze potential.
Yes. This is where the underlying fundamental business economics we just discussed collide head-on with the market mechanics we touched on at the very beginning.
It's the perfect storm.
The analysis report notes that DXST is a beaten-down stock carrying heavy short interest. Let's make sure we clearly explain what short selling means for you listening, because it is a very unique market mechanism.
Short interest simply means there are market participants who have actively borrowed shares of DXST from a broker and sold them into the market, betting that the price of the company is going to continue to go down. Their goal is to eventually buy those same shares back at a much lower price, return the borrowed shares to the broker, and pocket the difference as profit.
I think the easiest way to understand short selling is to imagine borrowing something physical.
Like what?
Imagine borrowing your friend's rare, highly collectible comic book. You look at the comic market and think the price is going to crash next week. So you sell your friend's comic book today for $100.
Okay.
Your plan is to wait a week, buy a copy of the exact same comic back for $50 when the market crashes, give the comic back to your friend, and keep a cool $50 in profit.
That is a great analogy. But it also perfectly illustrates the inherent massive danger of short selling. When you buy a stock normally, your risk is capped. If you invest $100, the worst that can happen is the stock goes to zero and you lose your $100.
Right.
But when you short a stock, your risk is technically infinite.
Going back to the comic book, what happens if, instead of the price crashing to $50, the artist suddenly becomes famous and the comic book skyrockets to $500?
You are in serious trouble. You still owe your friend that comic book. And because the price is now $500, you are forced to reach into your own pocket and buy it back at a massive catastrophic loss just to fulfill your obligation.
And when short sellers are forced to panic buy shares to close their losing positions, it creates an intense surge of buying pressure. Now, remember what we said at the very beginning about DXST having a low float?
The concert tickets.
Exactly. There are very few tickets available to this concert to begin with. So if short sellers suddenly panic and try to buy shares to cover their positions all at the exact same time,
it creates the conditions for a short squeeze. The forced, desperate buying pressure from the shorts trying to escape their infinite risk, combined with the severe lack of available shares and a low float structure, drives the price up at lightning speed.
it's explosive.
It really is.
Yeah.
And what the analysis report highlights is that DXST has a demonstrated historical ability to run 150% or more purely on retail momentum.
We've already seen the data on that intraday explosion to 29 cents. The mathematical volatility is absolutely there. So we are looking at a highly volatile setup. You have a company with heavy short interest, a structurally low float, and a core business that is quietly growing at nearly 70%. Any positive developments, say, a corporate announcement regarding new massive wastewater contracts aligning with those strict Chinese environmental mandates, could be the catalyst that forces the short sellers to capitulate.
Because the short sellers are currently looking at that temporary $322,000 net loss and assuming the company is structurally weak.
Right.
But if empirical data drops, proving that the core growth is actively translating into massive new municipal contracts, the shorts will realize they are trapped on the wrong side of a rapidly scaling business. The resulting rush for the exits in a low-float environment is a classic squeeze dynamic.
It is a brilliant illustration of how esoteric market mechanics and real-world business fundamentals interact.
It really ties it all together.
It does. Let's take a second to recap the journey we just went on for you. We started by looking past a chaotic 152% intraday stock surge. Instead of just stopping at the volatility, we used the analysis report to uncover a real, physical company operating in a highly critical environmental sector, generating $12.95 million in revenue.
And crucially, a company being driven by a 68.7% expansion in its core ecological river restoration and wastewater treatment division.
The ultimate takeaway here for you as a listener is that headline numbers rarely tell the whole story. If you just look at a temporary net loss of a few $100,000, you might naturally walk away.
Most people do.
Right. But if you don't take the time to dive into the segmental growth underneath, you miss the fact that they are aggressively investing to expand their kitchen and capture a massive government-mandated expansion in their most important market.
This raises a fundamental question for anyone evaluating growing companies. Is the business losing money because its product is obsolete? Or is it losing money because it is building out the necessary physical infrastructure to handle explosive, newly generated demand?
And the data on Decent Holdings strongly points to the latter.
Absolutely.
I want to leave you with a final thought to mull over today, something to really chew on as you go about your week.
Okay, let's hear it.
If a company is successfully securing vital environmental contracts, doing the highly complex chemical work of pulling industrial pollutants out of river systems, and growing its core operations by nearly 70%, yet is valued by the broader market at under $10 million and priced for absolute failure, what happens to the market dynamic when the reality of their ecological footprint finally outpaces the short seller's expectations?
It is the ultimate moment where fundamental value forces the market's hand.
It really is, and it makes you wonder how many other vital, fundamentally sound turnaround stories are out there right now. How many companies doing critical work are completely hidden behind messy, volatile microcap charts, just waiting for that operational leverage to finally kick in.
The market generates a massive amount of noise every single day, but there is always a clear signal if you're willing to look closely at the underlying data.
Thank you so much for joining us at the table today for this deep dive. We hope it gave you a new, more analytical lens through which to view these wild market movers. Keep questioning those headlines, keep looking under the hood to find the real story, and we will catch you on the next one.
Don't forget to like, share, and subscribe for more.